So we're going to calculate the stock price for ATD. This is a Canadian company, and the first step is we need the market cap, which is 48.41 billion, and then the stock price 43.10. So now we have the shares outstanding. To get that, it's market cap divided by stock price equals shares outstanding, 1.1 billion. Next is free cash flow. And the best way to calculate the stock price for a company is to estimate future free cash flow, then discount that back to today's dollars. And that's what we're doing in this video. This company only has 3 years of financial data on Yahoo, so I'm going to just also pull in the trailing 12 months. So I get, next is income tax, net income on the income statement, which is the profit and loss for each year. And then we need revenue. So it looks like they had a nice jump each year. And now we need to look at the capital structure of this company and figure out the discount rate we need to apply to the future cash flows. So the interest expense on the debt is 292 million. And current debt is 1.3 billion. That's debt due within a year. Long-term debt of 7.8 billion. That's debt due after 1 year. So they pay 3.2% interest on the debt, but interest payments are tax deductible. So let's find out their effective tax rate. And the income before tax is 2.2 billion. And the income tax is 371 million. So they pay 17% interest in taxes. So that means that cost of debt is 2.7%. So they have 16% debt, which isn't too bad. And now we need the cost of equity, and we need the beta to figure that out. So 0.71 is the beta, which is a pretty low volatility stock. And to calculate beta, we use CAPM, capital asset pricing model, and that comes out to 7.8%. And equity is more expensive than debt, as you can tell, because equity sits lower on the capital structure of a company. And in the event of a default, debt holders always pay before equity holders. And this number is the WACC, 6.96%. And this is the price this company pays to obtain financing. So they need to generate at least 7% every time they take on a project in order to add value to its investors. So we're going to discount the cash flows by this 6.96%. And we calculated the future free cash flow for years 1, 2, 3, and 4. And then all the years after that, we just used the Gordon growth model to calculate the future cash flows. We discounted those numbers back to today, and the value of the company is $52 billion, and if you divide that by 1.1 billion shares, that comes out to $46 a share, which is just about what it's trading at. It's trading at 43. So according to the model, it's a buy, but it's trading almost at intrinsic value. And it was trading at a discount in March, then it's come back up to where it was trading at before coronavirus. So stocks can obviously trade higher or lower than intrinsic, but the price is all dependent on the supply and demand of the market. And if you ever do analysis, you'll find some people saying this stock's a buy, other people say the same stock's a sell, but each analyst has their own model and their own ideas on a company, but you never actually see their model. This is my model and my opinion. Thanks for watching.